Hi, this is Samir Sawant, research analyst, Mirae Sharekhan. Welcome to our quarterly sector review, a research-led series where expert research analysts break down quarterly earnings, key sectoral trends, and what they mean for investors. Today, we dive into the banking sector for Q3 FY26 review. Public sector banks lead the charge, systemic stress recedes. Credit growth speeds up, credit-offtakes beats estimates by 14% versus expectation of 13% Y&Y growth. This was driven by GST rationalization, festive surge, and uptick in economic activities. Deposit growth too picked up but lacked loan growth. Banks' business momentum was healthy, with loan growth rising to 14.5% in Q3 versus 10.4% a quarter ago. Here's the key performance snapshot, which will be visible on your screen. Segments like Agri, MSME and retail saw better offtake. Within retail, auto, gold and housing loans increased by 16.5%, 128% and 11.1% respectively. GST rationalization, festive demand and good monsoons were key growth drivers. Deposits grew 12.6% but lacked credit growth, leading to higher CD ratio, that is credit deposit ratio. Overall credit growth for our coverage universe stood at 14%, of which public sector banks loan book was up 14.8% Y&Y, aiding market share gains, while private banks loan book was up 12.9% Y&Y. Credit to deposit ratio rose to 85.6% versus 83.9% Q-on-Q. Displayed on your screen is the segmental growth table. Margins were resilient. NII rose by 6.1% Y&Y and 3.6% Q-on-Q against our estimate of 5.6% Y&Y and 3.1% Q-on-Q. This was mainly on account of slightly better than expected NIM performance. Most banks, barring Bank of Baroda, PNB and Axis, clocked stable to improving margins as impact of repo rate cut was mitigated by repricing of deposits, lower cash reserve ratio requirement and change in loan mix in few cases. Non-interest income was up robustly by 25.9% Y&Y and 4.1% Q-on-Q, driven by higher fee income, treasury gains in few cases and better recoveries from return of accounts. Cost under control. Cost efficiency improved as cost to income ratio for coverage universe fell 90 basis points sequentially to 46.5%. Better asset quality also kept credit costs benign, aiding profitability. For our coverage universe, operating expenses were up 8.3% Y&Y and 1.9% Q-on-Q as banks showed improved cost efficiencies led by rationalized discretionary spends, leveraging tech and manageable impact of labor code. Asset quality was stable. GNPA are at multi-decade low of 2.1% as on September 2025, while net NPAs stood at 0.5%, shows improved balance sheets for bank. For our coverage universe, GNPA fell 11 basis points sequentially to 1.72%, while net NPA ratio declined 2 basis points to 0.43%. As per the data and management commentaries, stress in unsecured segments like credit card, microfinance and personal loan has largely peaked out and are normalizing. Our view, banks delivered a healthy performance in the quarter, characterized by stable operating metrics, accelerated loan growth and improvement in asset quality. Net profit for our coverage universe was up by 10.5% Y&Y, driven by PSBs, which reported a strong profit growth of 17.9% Y&Y, while private banks saw a modest PAT rise of 5.1% Y&Y. Combined PAT beat estimates by 5% on steady operating performance and asset quality improvement. ROA on a sequential basis was stable at 1.5%. In Q4, the sector is expected to maintain strong growth momentum and healthy asset quality, though margins may vary by institution as banks navigate the impact of RBI's December rate cut using available strategic levers. Preferred picks. Our top preferred picks are Axis Bank, HDFC Bank, SBI and City Union Bank. Our sector view is positive. Here's the full coverage universe table displayed on the screen. Thanks for watching. If you found this video useful, don't forget to like the video, subscribe and share it with anyone tracking banking as an investment theme. All of our research offerings are now under one umbrella, the Mirae Sharekhan Research Center. Explore research calls and detailed research reports across equity, mutual funds, FNO, commodities, ETFs, and more. Visit research.sharekhan.com to kickstart your wealth creation journey backed by our research experts. We'll see you in the next sector review. Thank you for watching.
Investment in securities market is subject to market risk. Read all related documents carefully before investing.